All right, welcome back to the Knights of Dissent show, episode 5. Unfortunately, Rats couldn't be with us here today, but we have Vinny.
Hi, everyone. I'm Vinny.
And I think today we'd like to go through the recent events surrounding Silicon Valley Bank.
I know. It's great stuff. You know, I was actually going to approach you and ask to do an episode talking about how the Knights Templar in the Catholic Church invented a form of inflation-free banking. So it was 100% reserves, and how they were actually shut down by European powers because they were becoming a powerful entity in and of themselves. But, you know, history has a way, or fate has a way of kind of sidelining things, but having you talk about the same concept, which is why we're here.
Yeah, eventually I'd like to do an episode on that particular subject, specifically surrounding the work of Louis de Molina.
Mm-hmm. Correct, yeah. But anyways, let's unpack the SVB blow-up.
So what is SVB?
Well, my understanding is that it is a technology lending bank, primarily. So they were a primary lender for startups and VC firms and people who were trying to get things started but didn't have a cash flow history that would allow them to apply for loans at more traditional banks.
Okay. And as I understand, they also had quite a large quantity of deposits from these industries, people in the tech sector.
Well, that's correct. So again, my understanding from the information that's come out is companies that had taken a loan from SVB usually also maintained cash deposits with them from their venture capital firms, which means that for a lot of companies, their entire cash ecosystem, so to speak, were held in trust at SVB.
Yeah. So they had a significant quantity of deposits. Also, huge amount in money market deposit accounts.
Correct. Now, walk us through the difference between money market deposit accounts and then regular deposit accounts.
Okay. So demand deposits are essential, also known as checking deposits, are when I go to the bank and I deposit my money, and I'm paid usually a fairly small interest rate on it. And during the time that I leave it deposited, the bank is allowed to go and lend it out at interest, and that's one way that banks generate net income. In a matter of speaking, demand deposits are really mutuum loans. They're not really deposits in the strictest sense.
Sure. And for the audience who may not really understand the different types of loans that an individual can give a bank, could you unpack the concept of a mutuum loan a little bit more?
Okay, sure. So historically, banks were originally more like storehouses for crops or gold or other things. So think about like a safety deposit box. When I go, let's say I have my grandma's necklace, right? It's a very prized possession of mine, and I want to keep it safe.
Sure.
So I would go to a bank and I would give them the necklace. I put it in a deposit box, and they have to keep a hold of it, right? And once I want it, they give it back to me. Now, in exchange for this service, I pay the bank a fee.
So it's a negative interest rate.
Or a negative interest rate, correct. So that's a basic deposit, also known as an irregular deposit. A regular deposit, okay, because the exact same necklace that I deposited is the exact same necklace I get out. Now, there are also irregular deposits, which would be like a corn silo. So if I go to the corn silo with my bushel of corn, I deposit my bushel of corn in the silo, and in exchange, I get a certificate that entitles me to 1 bushel of corn. Now, obviously, it's not the exact same bushel of corn that I put in, not the same grains of corn, but it's the same weight and quality of corn, right? And I pay the corn silo owner a fee or negative interest rate to keep hold of it.
Okay.
So mutuum loans mutual loans are when I give, essentially there's an implicit or explicit ability of the bank to loan out what I have given in deposit.
Sure.
Right. So instead of holding it in full fiduciary reserve for me, they are allowed to go and lend it out.
Now, when you say holding it in reserve, again, we're saying that it's an individual who's giving a loan to the bank, and that the bank takes that loan or takes that money that's being lent to them and then loaning it out at a higher rate of interest and then flowing some of that interest back.
Right.
In regular finance, we would call something like that a carry trade, correct?
That is correct. However, in banking, it is called a demand deposit, even though it is technically neither a regular nor an irregular deposit. It is actually a loan to the bank.
Okay. I believe the professor of finance, Richard Werner, goes through that, how
Yes, he does.
Banks, when you take a loan, there's three theories of banking, one being the intermediary theory, one being the fractional reserve theory, and then one being the credit theory.
Credit creation theory. That is correct.
And he says that the credit creation theory is the correct theory of banking because no money is actually taken out of other people's deposits and transferred into a loan to another person. It's actually invented out of thin air.
It is the creation of new, what some economists will call credit money or fiduciary media, which creates the possibility of double spending because money can be spent, it can be loaned out and spent. Simultaneously, you have an ownership claim to it as the owner.
Correct.
Which means that if you come in and demand all your deposit, the bank has to come up with cash to pay you.
Right, but that money doesn't exist. It's already been loaned.
Correct.
So let's tie that back a little bit more to SVB.
Right. So we were talking about there's two different kinds of deposits. There's in banking, there's two different kinds of deposits that we care about for this purpose. There's demand deposits, which is like we talked about. It's really a loan to the bank in cash. And then there's money market deposit accounts. So those are more explicitly loans. I take my money to the bank and I am giving it to them to invest in short-term securities.
Okay.
With these, and then I get a percentage of that interest paid back to me. Almost always, money market accounts pay significantly more interest than deposit accounts.
Yeah, I was talking to one representative. I think he was a financial advisor for Charles Schwab, and he was saying that their money market accounts are sitting at 4.5% right now, which is pretty astounding if you think about. It's pretty amazing that you can make 4.5% when S&P 500 is like chopping around so much. So
those are basically, that's the difference between demand deposits and money market deposits.
Interesting. Okay, so SVB had a lot of demand deposits and a lot of money market deposits. Where's the risk in a money market deposit? Would that be counterparty risk? So like your money is just straight up lost?
There is a risk there. And of course there are laws about fiduciary responsibility. And also I'm not sure to what degree money market deposits are insured by the FDIC, but they are insured.
I think money market deposits are privately insured. I don't quote me on that, but I think they are.
Okay. Yeah, I'll have to check that. But yeah. Okay, so yeah, that's the difference. And so SVB recently had a large demand for its deposits. The deposit holders required a large amount of cash for some reason.
Now, what do we know about that? Because there's a few different theories floating out or around out there right now, and that is one that VC firms realized that SVB could be illiquid because, and I think I sent you this a while back, about a week or so before. No, this was about Wednesday of last week. SVB sold about 1.8 billion, or took a 1.8 billion dollar loss on their portfolio of bonds.
Yes.
And then issued a statement requesting more money either through like a sale of equities or something like that.
Right.
And there was this panic, this bank panic, essentially, that SVB was illiquid.
Right, because one of the reasons, a couple of reasons for that. The main one being that these banks of this similar size to SVB recently have had a rather interesting structure on their asset side, where they have a lot of long-term treasury securities, which are not particularly liquid. So they were
What's
securities
the duration
that
on that? Would that be 30 years, 10 years?
I'm not sure exactly duration on SVBs, but these would be 10 to 30 year treasury securities. The idea, it was actually pretty smart at the time, was that these were purchased back when interest rates were very low.
Okay, sure.
And with the expectation that in the future interest rates will be somewhat higher. And the idea was to hold them possibly all the way to maturity as basically a stable stream of coupon payments for the foreseeable future, which made sense at the time. It made sense at the time to pay up that very high price for those.
Right. Okay. Yeah. So they would be more expensive, and at that duration, you could use them as collateral as a bank if you needed to.
Which made sense then, but when they had this, it's kind of a chicken and an egg problem. But when they had a liquidity problem, they had to go and sell these long-term treasury securities at a massive loss, because the prices of those, because interest rates are way higher today than they were when these were purchased.
Correct.
They had to take a big loss when they tried to sell them.
Sure. And to unpack that a little bit further, the price of a bond is dictated by the formula of coupon payment divided by the yield or the interest rate, which means that the same number divided by a bigger number equals a lower price. So as soon as they went out to the market to sell these securities, they got hit with this huge discount on the assets that they were holding. What's interesting here is, does this pose a problem for other banks?
Again, it depends on how their asset side is structured. If a lot of banks have a similar structure where they purchased a lot of these long-term treasury bonds at a very high price, then this could be a real problem for other banks. I'm guessing SVB wasn't unique in this regard. They don't seem to be particularly innovative in terms of how they're capitalized and how they manage their assets. So I would expect that this could be a problem for other banks as well.
Yeah. So, I mean, because a lot of banks, my understanding, just reading through a few uniform bank performance reports, is that they do shore up or hedge off some risk by holding treasuries or bonds of some type, so that they're not fully exposed to just loan payments as far as like their asset profile. Right, because those carry more risk. People can default.
Right. So a couple weeks ago, there was some turmoil involving something called Silvergate. Are you familiar with that?
I'm not 100% familiar with it. I haven't kept up with that. Would you mind walking us through what happened there?
I don't know. Okay. Yeah. Well, anyway, so there was something going on with Silvergate, which seems to have possibly been a trigger for this worry.
Yeah, interesting.
With SVB's depositors.
Interestingly, like the Wall Street Journal came out with this article like 2 weeks before SVB blew up, asking the question about whether banks were exposed to interest rate risk, and the conclusion is that they are.
Well, yeah.
I mean,
they
of
are.
Of course they are. But it poses an interesting problem of if we have this theory, and this actually goes into like a broader finance question of the Markowitz portfolio concept. I don't know if you're familiar with that, but the concept is like you have equities, which are your moneymaker, and then you hedge off risk with bonds because equities and bonds tend to be negatively correlated and move in opposite directions. The issue now, though, is with rising interest rates, it seems that there is a positive correlation between bonds and equities, which puts a lot of depository institutions between a rock and a hard place because now they're fully exposed to their bond portfolio and their equity or their loan portfolio as well. So their hedging scheme is not working the way it was intended
and
to.
from like an Austrian analysis, this makes sense because the catalactic interest rate is presumably higher than what the Fed attempts to set it as. So the Fed controls the left tail of the yield curve.
Yeah,
right.
short term.
And as the yield curve goes on, the Fed has less and less control unless it does a direct asset sale or purchase within that specific maturity.
Okay.
So it's understandable that as interest rates increase to more closely reflect the actual underlying rate of time preference of the public, that debt and equity will start to correlate positively.
Sure.
Instead of inversely.
Yeah, which, I mean, that's going to be a situation for all kinds of portfolio managers. I think we have seen a positive correlation situation in recent times. So it's going to be an interesting question about how to manage risk moving forward for all types of financial institutions. But back to SVB. So you have a situation where depositors basically make a run on the bank, and walk us through what happened on Thursday, because I know you called me and you were like, the financial markets are crashing right now.
Yeah, so there was this big panic as depositors were trying to get cash out of SVB, and there simply was not enough to cover it.
Which makes sense, being the fact that they essentially carried like a 0% cash reserve. 0%
yes,
ratio?
because the reserve ratio, the reserve requirements are set by the Federal Reserve by fiat. The Federal Reserve just sets them, and it's a binding rule.
Okay.
But the required reserve ratio has been 0 since 2020,
which is boggling from an Austrian perspective, because what that means is banks can expose themselves 100%.
Correct. Now, I would assume that most of these most larger banks are going to follow Basel, and they are going to be capitalized to 10%. Hopefully at the 10%, at minimum 3%. But they're going to most larger banks, especially if they're involved in the Forex world, are going to want to be within Basel limits. Right. So, but these smaller regional banks held by these bank holding companies have virtually no incentive other than the risk of their own default
demise
to retain high capitalization.
Yeah, that's fascinating, because what it implies is that there could be like a systemic problem in the regional bank sector where all of them have zero cash on hand. They're sitting on large unrealized losses in their bond portfolio. And if depositors decide that they want their money now rather than later, at the same time, that would be like the worst case scenario for a lot of them.
It's not this is always a concern, but with these holding securities, right? Securities that you're intending to hold to maturity, unrealized gain and loss is not something that you really keep track of.
Sure.
Because it's not report for financial accounting for most firms. It doesn't even have to be reported.
Right.
Because it's assumed that that's not an issue for them, which is different, of course, for trading securities. You have to report the gain and loss on those. But for holding securities, no. And when people are analyzing bank balance sheets, they're not thinking of the unrealized gain and loss on long-term debt securities.
Well, because that goes back to this interesting myth that is not really a myth per se, but maybe a pop culture placation, we could call it, but that is that treasuries are riskless, which they're not. They do carry interest rate risk, and they carry default risk. Now, the default risk is minimal, because in order for a treasury to be exposed to default risk, we're saying that the entire U.S. would have to default, and it's never even really come close to doing that.
Not in the United States. I mean, plenty of other countries have defaulted on their debt.
Sure. So the thing is, though, it's not a question of if we're going to default on our debt. It's a question of when, which means that, people are going to be looking a little more carefully at holding bonds moving forward,
Right.
and how that plays a role. I guess what I'm trying to stab at is people thought that bonds were relatively riskless, but they got caught in the crossfire of rising interest rates, and they didn't properly think of that risk and properly hedge out that risk or mitigate that risk in their operations.
Right. I think it's also interesting to see the speed at which SVB was placed under receivership.
It was
from
that
the time
day.
that the markets opened, it was about 4 hours.
Which is that's an incredibly fast time. I have some thoughts on that we can maybe circle back to. But
Yeah. I think that the FDIC realized very quickly that this could be a massive blow up, especially if any of the other major, because I mean we're talking when we talk about regional banks, on an international market, they're tiny.
Sure.
In terms of net worth, they're not enormous, but these bank holding companies are pretty large, especially for U.S. deposit holder. In terms of U.S. deposit holders, they represent most of the market. Like U.S. Bancorp, is huge, right? Bank of America is huge, right?
Correct,
Every city has a few of them. They're all over the place. And I mean, similarly, some of the larger banks like Wells Fargo. I'm not really sure how this will affect them, but I do think it is very convenient that there was a glitch in Wells Fargo's accounts the day that the entire market crashed.
Oops.
Oopsie. Yeah, that's Wells Fargo is known for being a very scummy bank in the banking world.
Yeah, it has an interesting reputation. That's for sure.
I wouldn't blame them, but that is a very clever way to come up with capital, just to have a glitch.
Yeah, right. One thing that struck me when I was watching this all go down on Thursday, or no, it was Friday, is the fact that even though regional banks play a relatively small role in the international banking system, they play a very fundamental role in the power and respect for the Fed.
Correct.
Because they deal directly with individuals. If JP Morgan would blow up, very few men on the street would be affected.
That's correct.
But if, let's say, Bank of America went insolvent, many Americans would be affected directly and would have a decreased trust, so to speak, of the financial system. It would be a direct challenge to the authority of the Fed and the financial system that they govern, which I think is why they moved so quickly to take it over and contain the contagion.
Right. So I'm just looking at the list of primary dealers. It doesn't look like any of them were seriously affected. There's JP Morgan, HSBC, Goldman Sachs, Deutsche Bank, Credit Suisse. Well, yeah, maybe. What happened there? What's with Credit Suisse?
I'm not sure. It's I've been trying to follow it. I don't know if it's tied to the SVB collapse or what's the situation, though. I do know that they are now being taken care of by the
ECB.
ECB.
Well,
European
yeah, but the
Central
ECB
Bank.
just raised rates. They just
Yeah,
the
by
ECB did not cave to pressure, and they raised rates anyway.
No, 50 basis points, which is interesting. I wonder if that's an indication of where the U.S. Fed is going to go.
Yeah, well, Powell's kind of he's like the stone-faced kind of I think as far as Fed chairs go, Powell is not going to as easily cave to pressure. I mean, remember in 2019. Wait, who was he? When was he installed as Fed chair?
Oh, I don't know. Let me look that up real quick.
Was he in during the 2019 repo blow up?
It's entirely possible.
Hold on, let me look this up. Let me check this out real quick.
So when was Powell appointed?
Yeah, so he was in. He's been in since 2018.
Okay.
So, I mean, he was pretty aggressive intervening with the first time, right? I mean, and that basically unwound all of the QE unwinding, or the quantitative tightening, right? The attempt to pull excess liquidity.
Correct.
And raise rates.
Well, we've seen this multiple times. It's not just a situation that's limited to the U.S. A few months ago, right, the British central bank had a situation with the gilt crisis that caused them to subtly walk back on a bunch of QE that they were trying to... Is it QT? I think it's QT.
Yeah, QT.
Yeah, quantitative tightening that they were trying to do, which indicates that you can't just flush the economy with liquidity and then take that liquidity out as easily as these banks would like to think that they can.
Well, the fact that they've not raised the reserve requirements and they're still raising rates, I mean, that indicates it's almost like they're trying to stimulate a bank crisis just to get it over with.
Well, I couldn't say, but they are between a rock and a hard place. There was an article in, I think it was the Financial Times this morning, or sometime this past week, that was talking about how now the Fed is faced with an interesting problem, which is, do you continue to raise rates and put banks on the precipice of failing, or do you walk back on the rates, let inflation kind of take over, but allow the financial system to stay stable? Right.
I think if Powell pulls through with the unwinding operation, one, it'll be basically the first time it's ever been done at this scale.
Sure.
I don't know of any country with a U.S.-sized economy that has ever managed QT. It's just not possible. At least not so far. It's proved to be virtually impossible. So if he does pull through, that will be interesting. That will be very interesting to see. And I think it'll be interesting to see the cultural ramifications of that, because we're sitting today on about 20 years of very loose credit. So we had Greenspan, loose credit guy, also kind of like an oracle. He's like this wizard man, the Pope of finance, who would like write these obscure statements, and then people would have to like interpret them. There would be like these dogmaticians trying to figure out what he meant by this. And then helicopter Ben, right? Ben Bernanke, right? Easy credit guy. Then there's Yellen, easy credit gal. And then we have Powell, who was pretty easy credit up until he tried once to do the unwinding operation. The repo market went bunk, and he's trying it again. Yeah. This time, basically starting completely from the beginning, because all of the QT was completely undone when they did the repo intervention. So you're having to unwind 4 rounds of QE plus COVID QE.
Well, yeah, and I don't think it's really working that well for him. I saw it was in an article earlier, or on a post from a channel that I subscribe to, saying that the Fed's balance sheet basically jumped up $300 billion this last week, which means that they're having to walk back on that QT if they're having to buy back treasuries from banks to maintain liquidity in the system and prevent further contagion from spreading, which poses like a whole different problem altogether. Is like, how are we going to like the Fed has this issue where every time there's a crisis, they come in and they suck up all the toxins.
And their balance sheet becomes bigger and bigger and more toxic.
Yeah. So the question is, at what point does the cure not work anymore, right? And that, I think, is a question that we need to start asking as in the financial community, as economists. Like, when does the Fed reach a point where it's poisoned itself? And it
can't go insolvent. It's the Federal Reserve. Theoretically, as a lender of last resort, I don't think it can go insolvent.
Well, technically it can't. In fact, the Fed changed the way that it reports assets and liabilities in a way that it will never go insolvent.
Yeah.
That was about 3 years ago or something like that.
But if Powell does pull through, I think the consequences will be quite beneficial to just society as a whole, because you have 20 years of easy credit, and that creates a view of money that I think is very, very destructive.
How do you mean?
Specifically, so on the banking end, you have this enormous moral hazard problem where it is assumed that virtually any financial institution of large enough size will basically be bailed out.
Correct. Yes.
That large financial markets like mortgage-backed securities, repo, will not be allowed to fail. There will be a liquidity pump whenever that's needed.
Sure. Which
leads to an attitude within the banking sector especially that I think is very toxic.
Well, yeah, I mean, it generates very risky behavior. Yeah. What is the medical condition where a person can't feel pain? I forget what that one's called, but you basically create a situation like that in the financial system where like banks and other depository institutions just continue to take on more and more risk because they know at the end of the day that they'll never have to suffer the consequences. And creditors are more likely to extend credit and make loans to them because they know that they'll hypothetically get their money back because they never have to suffer like true loss of capital. Right.
I think even at the consumer level, low rates create an attitude that is very negative. I mean, the idea that you finance cars and you finance a new car every 5 years is very weird. It is a phenomena of artificially low interest rates.
Correct.
The idea that you don't own a car forever, you get a new car every 5 years and you finance it because the rates are just so damn cheap.
Sure. Well, I mean, if we drift into the area of culture, you get into a situation with low rates where you fuel very rampant consumerism and rampant hedonism.
Well, also just the VC phenomena, the entire phenomena of just useless venture cap. Is a phenomena of low interest rates.
Yeah.
There is so much. I mean, it looks like that may have been the trigger for this was venture cap. But there's all kinds of venture cap, little tech companies that are venture capped that and they just produce absolutely nothing of value.
Venture capital is as you said, a phenomena of easy credit. It's funny money going into funny companies. I mean, I was sitting in a panel talking to some finance leaders in the community, executives and whatnot, and they were talking. One of them represented a venture capital firm, and he was talking about how 80% of his businesses that he invests in fail. And I was thinking to myself, what other business could you take losses on 80% of your book?
Yeah.
Right? I mean, if this was a portfolio manager, like this would just be unacceptable. They'd be fired.
Yeah.
But these firms can somehow continue along, right? Just pumping money into these zombie companies.
Yeah, I mean, even like banks. Like a bank can't. If 80% of home loans a bank issued defaulted.
Well, I mean, that would be 08 all over again.
It would be disaster. Yeah, like no business could survive that.
Right. But as long as there's money coming along from, as long as there's money coming along from Uncle Sam, and people don't people feel comfortable throwing it wherever, at whatever risky venture that they can, in hopes of making like this big payout or big reward. They will. And unfortunately, I think the blow up in the tech sector and the blow up in the tech banking sector is directly tied to this quantitative tightening.
And taking a 10,000-foot view, this blow up, if it actually detonates the financial markets, I don't know if it will. I don't know if Powell will chicken out and do what he did in 2019. But if this blow up does happen, a lot of people are going to be completely up a creek, and basically their finances are going to be ruined. A lot of people's, if this spreads, a lot of people's retirement funds are going to be blown away in an instant. However, I would argue that the more lives were ruined by the easy credit than the blow up. Because if you look at the consequences of low interest rates on people, especially young people, when you have low rates, right, what prices increase? Well, it's the prices of capital goods that you borrow money to to purchase, and it's also the price of consumer goods that you borrow money to purchase. So, right, groceries, right? Have you ever taken out a loan to go buy groceries?
No.
Have you ever taken a loan to buy a new computer?
No.
You've probably taken out a loan to buy a car or to get a university education. Those kinds of things.
So personally, no, but I understand everyone pretty much has.
Right. And when you have very low rates, you're essentially getting malinvestment in those markets.
Sure, because
and the demand for those goods and services increases, and the price increases enormously. Combine that with cartelization, especially within the healthcare and education sector. The past 20 years have seen extreme cartelization, where you have two industries. You have accredited universities, and you have med tech companies and hospitalists.
Sure.
Who are cartels. They are now increasingly guaranteed a future stream of cash, because in the case of education loans, they can't be forgiven.
Yes.
And the government basically ensures that they will be paid.
Yep.
So you have no price competition. You have no incentive to lower your tuition rates at all. Right? What goods, right, in an effective competitive market, the trend, all other things being equal, of prices is to decrease. Right? The trend of the quality of service is to increase. Right? I mean, I'm looking around and it looks like consumer goods got better in the past 20 years. Like computers got better, they got cheaper, right? Why hasn't healthcare gotten better and cheaper? Why hasn't university education got better and cheaper? Because you have low rates, you have loans for these things basically backed by the government.
Yeah.
And no price competition whatsoever.
Yeah, I completely agree. I've got two things to add to that. First, in his book, The Psychology of Money, Morgan Housel talks about in his chapter 1 how the economic environment that exists in a person's 20s shapes their relationship with money through their lifetime. So when you talk about low rates and easy credit ruining countless people's lives, I kind of hear that and I think to myself, it's true, and it's our generation.
Yeah.
Because we are addicted to this idea of I want it, I've got it sort of situation.
Right. Moreover, your investment in your 20s, right, had low yield because rates were so low. You had low yield and high inflation.
Yeah.
You had a period, over the past 20 years, prices have, for most consumer goods, have at least doubled. Right. And in the case of education, tripled. Right.
Yeah.
Meanwhile, you're getting, bum yield. Right. You have to invest your money unless you want to lose it all to 2% inflation, 3% now, 6% inflation a year. You have to invest it, and the yields aren't that good.
No.
And yeah, your relationship with money, your ability to start up capital is ruined. Right. Because it's not it's not it's the number of compounding periods that matters.
Correct.
Right.
Correct.
If you don't start out, I mean, that's anyone who works with annuities, anyone who works in like the retirement industry, because it's like an industry now, because it has to be, knows that it's the number of payments, right?
Correct.
It's when you start investing young.
Yeah.
That's how you're able to succeed. And if every single year the value of your savings are just being eaten away, and the only way to stop them getting eaten away is basically to invest them in poor yields, at least the stock market's been good. That's not going to be the case for much longer.
Right. Yeah.
Right.
And the consequence I see, right, to your point, is we're in the situation where young individuals like ourselves cannot invest in their future, their retirement, in a meaningful way. I'm not talking about Social Security. I'm not talking about 401ks. I'm talking about accumulating wealth, real wealth, and being independent and financially free by the time you're 65. It's just, the more inflation rises, the less likely it is that you're going to be in a good financial position by the time you're 65. And to your point, like, the consequence of that is well, if I'm just going to have to be on the government dole when I'm that old, why not just spend all of my money now?
Right.
So you get into this situation where we're not thinking about the future, we're living for today, and there's much more harm to be had and in that type of mentality.
Yeah.
So drawing that, like, that's like a 10,000 foot view of like the cultural ramifications of the financial system. Let's talk a little bit more about what's happened recently. FDIC has taken over SVB Bank, but more importantly, it's not that they just insured customer deposits up to 215,000. 250,000. They basically said, carte blanche, we're going to pay whatever it is that you are owed, full restitution. So what are we looking at? More inflation?
Well, possibly. The FDIC, banks pay in a certain amount of money to deposit insurance. It's a fee they pay every year. Whether or not the FDIC has, I believe the FDIC only has enough to cover about 2% of customer deposits in the United States.
Okay.
So, and that's 2%. Yeah, so it's to cover about 2%. A supermajority vote from the board can insure above the $250,000 consumer deposit limit. Okay. So who knows? Like, if more banks fail, are they going to play favorites? Are they going to fully insure some, not others? Are they? I mean, where are they going to get? I mean, the FDIC is not self-funding, unlike the Federal Reserve, which is essentially self-funding because it's an ostensibly private institution. It doesn't receive tax money. The FDIC is a different story. They're going to have to get that money from somewhere if they're going to insure large quantities of customer deposits.
You know, the difficulty I see, or the potential moral hazard that I see, is that the financial system is going to come out of this more socialized than when it started, right? See, instead of allowing the banks to fail, or allowing there to be that kind of pain in the economy, which would hurt people, but I fundamentally believe we would be able to rebound from that, the banks are going to get bought up, scooped into this broader regulatory framework that really socializes them more as an arm of the government and an arm of the Federal Reserve rather than being independent. And I think that's why we see the issue more in regional banks or with regional banks.
Yeah. Yeah, I don't know. I mean, if the contagion spreads to larger banks, might not be an issue.
Okay.
But yeah, it depends. It depends on how well those larger banks how well they've capitalized, how smart they've been. Some of them, Wells Fargo.
I don't know.
Wells Fargo. I'm just looking at that one, and not too confident in that one. But
not investment advice.
I wouldn't would never place deposits in Wells Fargo, even if it wasn't a banking crash. But yeah,
Fair enough. But are we looking at a situation where there's more inflation? Because as you said, like insured up to 2%, but past that, are we just gonna have to turn on the money machines and like get at it again? You know,
depends on where they get the cash from. It could be essentially an act of Congress where you just have this massive deposit insurance tax levied on everyone. But
I mean, doesn't that seems a lot like robbing Peter to pay Paul?
It's more like robbing Paul to pay Paul.
Yeah, it doesn't seem to really help anything, but okay, I can see that.
Other than that, you could have a giant OMO from the Fed. You could have a giant specific asset purchase. The Fed could flush liquidity into a specific sector.
Okay. The problem with that, though, is any liquidity that goes into a single sector will bleed over to other sectors.
Yeah.
So net, it's going to just raise inflation.
I mean, I think the smart thing to do is basically just let the banks fail. Because long term, it's not politically popular, but in the long term, I don't really see any other option.
Well, I agree with you. I see it as not a matter of if, but a matter of when. You know,
Now, being independent as the Fed is, there's more leeway there than with the FDIC. In fact, I would prefer, if at all possible, in the next couple of years, for the Fed to basically be in charge of this process and not the FDIC, because the Fed is, ironically, a fundamentally reactionary institution. It's a dictatorship run by Powell. Right, it's run by Powell.
Yeah.
He doesn't have to listen to anyone. The only thing that the U.S. president could just appoint a new chair. That's the only way. That also, things that he does don't seem to reflect as badly on him as they would an elected politician.
Sure.
Or they would even a more public face like the FDIC, which is directly insuring deposits. So if anyone can do anything, it's probably the Federal Reserve, because they are the ones that can do it with the least blowback.
Right.
Because they are so unaccountable, they can do things that are necessary.
Yeah, I get what you're saying. I mean, market dips 2% every time Powell opens his mouth, but that doesn't change.
No,
doesn't change anything.
Well, like I said, he's kept the reserve ratio at 0, and he's still jacking up rates. I mean, it's almost like he wants a banking crash.
Do you think? I mean, this is all speculation. Maybe we don't want to wander there.
It's not exactly unpredictable. But...
Sure. So, what do you think are going to be like the next steps as far as like the economy? Banking?
I think there's going to be a massive media circus about bank regulation.
Sure. Well, that's almost a foregone conclusion.
We're going to have Barney Frank in front of Congress again for months, and I think that's basically what's going to happen. Hopefully, with all that hullabaloo, Powell can just raise rates another, 50 basis points every 6 months.
Yeah. Now, interestingly, do you think? What do you think of like deflation? Do you think deflation would be a helpful or useful thing at this point?
It would depend on what you mean by deflation. If you mean like QT, yes.
Well, yeah, QT, but like having people shore up funds, not spending as much on consumer goods, less like a decreased velocity of money in the overall
I think that would be
ecosystem
good.
Economy.
I think there needs to be, with a lot of these VCs, there needs to be a massive discounted sell-off of capital goods, not financial capital goods.
Capital goods like plant, property, equipment.
Yeah, plant, property, equipment, machines, buildings, houses.
Okay.
Are houses a consumer good? Okay, they're considered investment in GDP, so I'll consider them capital. Yeah, there's going to be a big sell-off, at a discount. People are going to take a haircut. Big whoop. But in the long term, the economy is going to be much more healthy for it because all these useless lines of production that people have been investing in for the past 20 years and all these silly McMansions that people have been buying with cheap mortgages for the past 20 years are going to have to be sold off at a discount. They're going to be bulldozed, and you're going to build starter homes where they used to be.
Yeah, I mean, again, it's politically unpopular, but I actually do see that as a positive potential.
Yeah, I want people's mortgages to go up.
For like the youngest generation, right? Like as a 20-something-year-old, I'm looking at a situation where homes are unaffordable, the price of everything is going up. If a situation were to happen where suddenly like homes just were on the market for very, very little money, or an affordable amount at my rate, it would be a good thing for the youngest generation to make moves, buy up capital, start businesses, and start that whole business cycle over again.
You know what would be real funny? This would be a little funny troll that Congress could do. Make university accreditation basically like applying for an LLC. Think about it.
Yeah.
Any jackass can go to their state education board and pay like a $1,500 fine to become an accredited university. That would be hysterically funny. I'm serious. It would destroy the industry. It would bring prices way down. There'd be a collapse of major both Ivy Leagues and large state research universities. There would be a massive, essentially a sell-off of capital and a bunch of smaller universities, because in real life, I mean, online universities are good enough for a lot of jobs at this point.
I was actually writing a research paper on this. It's like most jobs now aren't even requiring a university degree, because even in like advanced professions, because they realize that the quality of the human capital coming out of modern day universities is not as good as it should be.
I mean, Brian Kaplan said this like 10 years ago. Yeah, this is not unknown in the economics profession.
Right. And companies, the common mantra I hear now is like, don't really bother passing your classes because we're going to have to train you to do it anyway.
Right.
So it's like, why bother go to class? Why bother going to school in the first place?
Right.
You could just have a recruitment program right out of high school.
Yeah.
Where you sign a contract that agrees that you're going to go work for the company for 4 years.
Yeah, exactly.
But in the meantime, they will literally train you on everything that's related to your job. So, that's a possibility there. But I agree. I think modern education, or the higher education system, has to change fundamentally.
Yeah.
Away from whatever it is today.
Yeah. And I think the best way to do that would basically just make it an open market. Just completely troll the entire education system by giving out accreditations. The state will just like, $1,500, you're an accredited university.
Let's go.
Okay. Sal Khan from Khan Academy, why isn't he an accredited university?
He could.
There's more information on there than any one state university has.
Sure. I mean, Udemy.
At an undergraduate level, there's more information there on that website.
Yeah.
Than you could get at virtually any state university.
Correct.
Why isn't he an accredited university? Why isn't Khan Academy? Why, if I do all my little exercises on Khan Academy, why don't I get a bachelor's degree?
Sure. Udemy, right? Udemy has a huge knowledge base from industry professionals. LinkedIn Learning. You can even get why is Google? I was looking and seeing that Google offers like certification in certain fields of study. They could become an accredited university. You pass the course.
Yeah.
You get your little certificate. And
I know the Mises Institute has been trying to get accreditation for their master's program. It's a huge pain. It's a huge pain.
Yeah, I know.
It's bureaucracy. It has nothing to do. I mean, their entire faculty is PhD economists. Some of them teach at the University of Auburn across the street.
Yeah, but it's a state-run. That's the problem with state-run institutions.
It should just be like an LLC. Like you just walk in with your business license.
I completely agree. And I think it would be net very positive for pretty much everyone in the economy at this point. Like I said, it would be a good thing for young people.
Yeah. Well, I think I've wrapped up everything I want to say. Is there anything you'd like to add to our talk today?
No, it's going to be interesting to see what happens in the next week. Markets have been super choppy afterwards. Like every prediction I've made always gets like
There's a little
wrangled
secret
up.
about bank holding companies. This is not financial advice, by the way. I'm not a financial planner. It's not financial advice. Bank holding companies are often publicly traded, which means you can short them.
This is true. This is true.
Very easily short them. I'm not saying that you should. This is not financial advice.
That's
But
true.
You could.
Yep.
You could short them.
JP Morgan.
That's right. Also, a lot of tech venture caps, specifically in the health and therapeutics sector, also publicly traded.
Although I will say this, last week, Friday, financial sector down 3%. You know who did well? All of the medical companies.
Really?
Biotech was up. So I don't know what's going on there.
Yeah, today there was this huge wipeout of like these like smaller biotech stocks just took a massive hit. Anyway, that's all for this week's episode.
Yeah.
Anything else?
No, that's it for me. I'm a guest, Vinny.
All right. This has been Knights of Descent, episode 5. We'll see you all next week.
All right, take care.